life happens. Weddings, births, career changes, relocations, separations, and loss are all inevitable parts of the human experience. What's less obvious is that every single one of these moments has financial and tax consequences. Many Canadians wake up on April 30th to discover they've missed critical deductions, triggered unexpected tax bills, or failed to take advantage of planning opportunities that could have saved them thousands of dollars. Here's what we'll cover: getting married or becoming common law, having a child, and buying your first home. Stick around, the strategies in here add up to real money. Getting married or becoming common law. Your relationship status is one of the most consequential tax categories in Canada. The status change. For tax purposes, your relationship status changes on the date of marriage or the date you meet the common law definition. This date matters because it determines whether you can claim spousal credits, which benefits you receive, and how certain income is split. The spousal amount credit. One of the biggest tax benefits of marriage is the spousal amount of $16,452, 2026 amount. If your spouse has little or no income, you can claim this credit on your federal return. Here's how it works: the spouse must be your legal spouse or common law partner. Your spouse's net income must be below the threshold. The unused portion is available to you. You can't both claim the same person as a spouse. At average federal tax rates, this credit is worth approximately $2,500 plus in tax savings. Canada Child Benefit, CCB, recalculation. If either you or your new spouse has dependent children, your CCB entitlement will be recalculated based on your combined family income. If you both have children from previous relationships, family net income now includes both incomes, which could reduce benefits for both children. Key points: CCB is based on family net income in the prior year. The higher combined income may reduce or eliminate CCB for higher earning families. Conversely, if you were previously higher income but marry someone with low income, your new combined income may be lower, increasing CCB. Notify CRA within 30 days of status change to ensure timely adjustment. Gulf Standard Time/Hawaii Standard Time credit. Similar to CCB, your Gulf Standard Time/Hawaii Standard Time credit is recalculated based on family net income. A marriage to someone with higher income can reduce this quarterly benefit. Pension splitting eligibility. Once married or in a common law relationship, you become eligible for pension income splitting. If you're 65 or older and receiving eligible pension income, you can split up to 50% with your spouse, provided they're a Canadian resident. This is extremely valuable for couples with significant income gaps. Strategy tip: if marriage will reduce combined benefits, CCB or Gulf Standard Time/Hawaii Standard Time credit, consider deferring the official registration to the following calendar year. However, for common law relationships, the 12-month cohabitation period must be complete before the tax benefit applies, so you can't control the timing as easily. Here are the key insights to take away. The spouse must be your legal spouse or common law partner. Your spouse's net income must be below the threshold. The unused portion is available to you. You can't both claim the same person as a spouse. At average federal tax rates, this credit is worth approximately $2,500 plus in tax savings. Having a child. A new baby is expensive, but it also comes with one of Canada's most valuable non-taxable benefits, the Canada Child Benefit. Canada Child Benefit, CCB. The CCB is a tax-free, monthly payment from the government for children under 18. The amount depends on your family net income and the child's age. For a family earning less than $35,000, full benefits apply. For higher income families, benefits gradually reduce and phase out completely around $173,000 for families with one child. Amounts vary by family size and age mix. Childcare expense deduction. If you or your spouse earn employment or self-employment income, you can deduct eligible childcare expenses. The deduction is claimed by the lower-income spouse, in most cases, and is limited to, up to 2/3 of the lower-income spouse's earned income, a maximum of $8,000 per child under 16, a maximum of $5,000 per child 16 plus, with a disability or infirmity. Eligible expenses include daycare centers, babysitters, day camps, and overnight camps, if they provide childcare. Nanny wages, CPP contributions on nanny wages, and certain other childcare services qualify. Registered Education Savings Plan, RESP. And RESP is a registered account designed to fund a child's post-secondary education. The big advantage, grants. The government matches 20 to 40% of your contributions. If you contribute $2,500 to an RESP in the year your child is born, the government immediately adds $500, 20% CESG. That's free money. Even if investment returns are modest, you've guaranteed a 20% return on that contribution. RESPs have annual contribution limits, $50,000 per beneficiary lifetime, but contributions are not deductible on your personal return. The growth in grants compound tax-free until withdrawal for education. Maternity/parental leave EI benefits. If you take maternity or parental leave and receive EI benefits, those benefits are taxable income. However, you can use the deduction for employment insurance premiums and parental benefits to offset some of this tax at no cost. This effectively gives you a small refund on the extra income caused by parental benefits. Here are the key insights to take away. Children under 6, up to $8,157 per child per year, 2026. Children 6 to 17, up to $7,997 per child per year, 2026. Buying your first home. Homeownership is central to wealth building in Canada. First Home Savings Account, FHSA. Introduced in 2023, the FHSA is a game-changer for first-time home buyers. Here's the framework. You can contribute up to $8,000 per year, 2024 to 2025, lifetime contribution limit, $40,000. Contributions are tax-deductible, similar to RRSP contributions. Growth inside the account is tax-free. When you withdraw to buy your first home, the entire amount is tax-free. This is essentially an RRSP-like account with tax-free growth and tax-free withdrawal, not just deferral. If you're a first-time buyer, prioritizing FHSA contributions before RRSP contributions can make sense. Home Buyers Plan, HBP. If you haven't maxed your FHSA, you can also withdraw up to $60,000 from your RRSP under the Home Buyers Plan, tax-free. This allows you to use pre-tax retirement savings to fund a home purchase. Key conditions: you must be a first-time home buyer, haven't owned a principal residence in the past 4 years, the home must be in Canada, you must repay the amount to your RRSP over 15 years, or you'll owe tax. The withdrawal doesn't trigger immediate tax, but the amount is removed from your RRSP. Home Buyer's Amount. This is a one-time credit for first-time home buyers. If you buy your first home in 2026, you can claim a federal credit of approximately $1,500, based on a $10,000 eligible amount, plus a provincial credit. It's relatively small, but it's automatic if you qualify. Land transfer tax credits. Several provinces offer land transfer tax exemptions or rebates for first-time home buyers. Ontario, for example, rebates the entire land transfer tax, up to $2,000, for homes under $500,000. Check your provincial government's website for details specific to your province. Strategy tip: if you have FHSA room, maximize it before using the HBP. FHSA withdrawals are completely tax-free and don't need to be repaid. HBP withdrawals must be repaid, and if you don't, the amount is added back to your taxable income. Many first-time buyers should prioritize FHSA over HBP for this reason. Here are the key insights to take away. You can contribute up to $8,000 per year, 2024 to 2025. Lifetime contribution limit, $40,000. Contributions are tax-deductible, similar to RRSP contributions. Growth inside the account is tax-free. A few more to keep in mind. When you withdraw to buy your first home, the entire amount is tax-free. Getting divorced or separated. Divorce is emotionally difficult and financially complex. Asset transfers between spouses. When you transfer assets to your spouse, or ex-spouse, as part of a separation agreement or divorce settlement, those transfers occur at adjusted cost base, ACB, not fair market value. This is a major tax advantage. No capital gains tax is triggered on the transfer. Spousal support, alimony, tax deductible for payer. If you pay spousal support under a court order or written agreement, it's tax deductible for you and taxable income for the recipient. This can reduce the net cost of support payments, especially if the payer is higher income. Payments must be made to the ex-spouse, not a third party. A written agreement or court order must exist. Payments must be periodic, regular, not a lump sum. Important distinction: spousal support, alimony, is tax deductible/taxable. Child support is not. If you pay $2,000 per month in spousal support and $1,000 per month in child support, only the spousal portion reduces your taxable income. This is a common source of confusion and mistakes at tax time. RRSP splitting via court order. When you divide RRSP assets as part of a divorce, you can split them between you and your ex-spouse via a court order, called a matrimonial property order or similar, depending on your province. The recipient can transfer their share directly into their own RRSP without triggering tax. This is different from a regular RRSP withdrawal, which would be fully taxable. Always use a formal court order or memorandum of understanding specifically mentioning RRSP division to enable this tax-free treatment. Loss of spousal and dependent credits. Once you're divorced or separated, you can no longer claim the spousal amount credit or dependent credits for your ex. Your tax cost goes up immediately in the year of separation. Plan for this by increasing tax withholding or setting aside funds if you were benefiting from these credits. Recalculation of benefits. CCB, Gulf Standard Time/Hawaii Standard Time credits, and other income-tested benefits recalculate based on your individual net income. If you were lower income in a high-income household, separation may actually increase your government benefits. Planning tip: timing of a separation within a tax year matters. Income earned before separation may still be combined for benefit purposes, depending on the benefit. Consult a family law lawyer and tax professional together to optimize the timing. Here are the key insights to take away. Payments must be made to the ex-spouse, not a third party. A written agreement or court order must exist. Payments must be periodic, regular, not a lump sum. Losing your job. But from a tax perspective, it can create unexpected opportunities if you plan carefully. Severance packages are taxable. If you receive a severance package, severance pay is fully taxable income in the year you receive it. It doesn't matter if it's called a severance, termination payment, or golden handshake, it's income. Example: Chris loses his job and receives a $50,000 severance package in July 2026. He also receives $15,000 in regular employment income before losing the job. His total 2026 income is $65,000. Even though the severance was sudden, it's all taxable, and he may have ended up in a higher tax bracket than usual. RRSP transfer window. Some severance packages include eligible severance and termination payments that can be transferred directly to your RRSP. Specifically, payments for unused vacation and used sick leave, and certain other benefits can be transferred tax-free if you have RRSP room. These are called eligible severance payments. If your severance includes eligible components, ask your employer or severance administrator whether a direct transfer to RRSP is possible. This can dramatically reduce your tax bill for the year. EI benefits are taxable income. Employment insurance, EI, benefits are taxable. When you receive EI, you'll get a T4E slip in early 2027 reporting the benefits received in 2026. Many people don't realize this until tax time, when they owe unexpected tax. You can request to have tax withheld from your EI benefits, up to 20%, to avoid a large tax bill in April. Ask Service Canada about the tax deduction option. Low income year equals RRSP opportunity. If you lose your job partway through the year, your 2026 income may be lower than usual. This is an opportunity to make strategic RRSP contributions and claim them against your lower income, generating a refund. The refund can then help you pay for expenses while unemployed. Strategy: if you have RRSP contribution room and received a severance, consider making a maximum RRSP contribution in December 2026 to reduce your taxable income for the year. If unemployed for part of the year, your effective tax rate will be low, and the refund can provide cash flow relief. Death of a spouse. Death is the ultimate life event with profound tax consequences. Deemed disposition on death. When someone dies, they're deemed to have sold all of their assets at fair market value immediately before death. This applies to stocks, bonds, and investment portfolios, real estate, except principal residence, cryptocurrency, collectibles and art. Any unrealized capital gains trigger tax at the time of death. If the deceased had a $300,000 investment portfolio with a $100,000 unrealized gain, that $100,000 gain is added to the final tax return and taxed. Spousal rollover, major planning tool. If the deceased spouse transfers assets to the surviving spouse, or transfers assets to a trust for the surviving spouse's benefit, the assets can be valued at adjusted cost base for tax purposes, deferring all capital gains tax. The surviving spouse then inherits the same ACB and pays tax only when they eventually sell. This is one of the most powerful tax deferral tools in Canadian tax law. A spousal rollover can defer $100,000 plus in capital gains tax indefinitely, until the surviving spouse's death or sale. RRSP and RRIF treatment. RRSPs and RIFs are included in full in the deceased's final tax return. The entire account balance is taxable income. However, if the RRSP/RRIF is transferred to a spouse, the transfer can be done at cost base, no tax to the deceased, and the surviving spouse assumes the account and can continue tax-deferred growth. If transferred to an adult child, age 18 plus, the entire amount is taxable to the deceased unless the child is financially dependent. Principal residence exemption. The home is exempt from capital gains tax when sold or deemed sold, on death. No tax is triggered on the home's appreciation, which is one of the few capital gains that escape tax entirely in Canada. Final return filing. An executor or representative must file the deceased's final tax return by June 15 of the year following death, or the normal deadline if later. This return reports all income up to the date of death, capital gains from deemed disposition, and final credits or tax owing. If a refund is due, the estate receives it. If tax is owing, it must be paid by the executor from estate assets. Here are the key insights to take away. Stocks, bonds, and investment portfolios. Real estate, except principal residence. Cryptocurrency. Collectibles and art. Moving for work or school. A job change or relocation can trigger a valuable deduction, moving expenses. The 40-kilometer rule. You can deduct moving expenses if you move to take a new job and the new residence is at least 40 kilometers closer, by the shortest normal road route, to your new workplace than your old residence was. Key point: it's about distance to the workplace, not about moving to a different city. You could move across town and still qualify, or move to a new city and not qualify, depending on where your old and new jobs are located. Eligible moving expenses. You can deduct the following: selling costs, real estate commissions, legal fees, inspection costs, appraisal fees for selling your old home, legal and notary fees, for purchase of new home, travel costs, airfare, mileage, or taxi/accommodation for you and family to move, temporary accommodation, up to 15 days of lodging, meals, and utilities while looking for permanent housing, lease cancellation, breaking an old lease early to move, utility hookup and disconnection, telephone, internet, hydro, water, gas setup and disconnect fees, mail forwarding, postal forwarding services, movers and trucking, professional movers, truck rental, packing supplies. How to claim. Moving expenses are claimed as an employment deduction on line 22,900 of your tax return. You must provide receipts and documentation. Keep everything: real estate transaction statements, legal invoices, mover quotes and invoices, hotel receipts, travel receipts. Documentation is critical. CRA audits moving expense claims frequently. If you claim $20,000 in moving expenses but can only produce $10,000 in receipts, CRA will disallow the unsupported portion. Save every receipt, every invoice, and keep a moving expenses log documenting what you spent and why. Timing. You can only deduct moving expenses in the year you move or the following year. If you move in 2026, you can claim expenses in 2026 or 2027, but not later. Here are the key insights to take away. Selling costs, real estate commissions, legal fees, inspection costs, appraisal fees for selling your old home. Legal and notary fees, for purchase of new home. Travel costs, airfare, mileage, or taxi/accommodation for you and family to move. Temporary accommodation, up to 15 days of lodging, meals, and utilities while looking for permanent housing. A few more to keep in mind. Lease cancellation, breaking an old lease early to move. Utility hookup and disconnection, telephone, internet, hydro, water, gas setup and disconnect fees. Mail forwarding, postal forwarding services. Movers and trucking, professional movers, truck rental, packing supplies. Life Events Quick Reference Tax Guide. The table below summarizes the key tax actions, deadlines, and estimated impacts for each major life event. Marriage/common law. Key tax action, update CRA status, claim spousal amount, notify for CCB/GST credit recalc. Critical deadline, within 30 days of status change. Estimated impact, $1,500 to $3,000 annual savings or loss of credits. The table also covers birth of child, home purchase, first time, and divorce/separation. Check the row that fits your situation. Key takeaways and planning principles. As you navigate major life events, keep these principles in mind. Here's the order: notify CRA early, status changes, marriage, divorce, new child must be reported within 30 days. Delays can result in incorrect benefit payments and overpayment of tax. Keep receipts. From moving expenses to childcare to RRSP contributions, CRA will ask for proof. A receipt is worth its weight in tax savings. Use registered accounts strategically. FHSA, RRSP, RESP, and TFSA all have different purposes and tax treatments. Match the account to your life stage and goal. Plan for timing. The year an event occurs matters. A divorce in January versus December changes your tax calculation. A move for work in June versus December affects the moving expense deduction. Lower income years are opportunities. Job loss, parental leave, and sabbaticals create low-income years that are perfect for RRSP contributions and claiming non-refundable credits. Spousal coordination saves thousands. Marriage and divorce both affect household tax. Coordinate claimed deductions and credits across both spouses to minimize combined tax. Get professional help for big events. Divorce and death are complex. A family lawyer, estate lawyer, and tax professional working together can save the family 6 figures. DIY planning here is risky. Continuing, use registered accounts strategically. FHSA, RRSP, RESP, and TFSA all have different purposes and tax treatments. Plan for timing. The year an event occurs matters. Continuing, lower income years are opportunities. Job loss, parental leave, and sabbaticals create low-income years that are perfect for RRSP contributions and claiming non-refundable credits. Spousal coordination saves thousands. Marriage and divorce both affect household tax. Continuing, get professional help for big events. Divorce and death are complex. Final thoughts. But the tax consequences don't have to be surprising. By understanding the tax implications of marriage, children, home ownership, divorce, job changes, relocation, and death, you can make decisions that protect your wealth and keep more money in your family's pocket. The numbers are real. A marriage can save you $2,000 plus per year in credits. A child triggers $16,000 in annual benefits. A first home unlocks $8,000 in annual FHSA contributions. A divorce can shift tens of thousands in liability. A death can trigger a six-figure tax bill unless planned properly. Each of these events is an opportunity to review your tax position, update your beneficiaries, and align your planning with your current life stage. Don't wait until April 30th to deal with tax. Deal with it as life happens. If you'd like personalized guidance on how any of these events affects your specific situation, consider consulting a tax professional or certified financial planner. The cost of the consultation will likely pay for itself many times over. Ready to optimize your tax position? Life events are predictable. Tax planning shouldn't be. Download our comprehensive tax planning ebook to learn strategies for every major life stage, plus a personal tax calendar to help you stay on top of deadlines and opportunities all year long. You've got the playbook. Keep optimizing.